Welcome to 1 Minute Mastery. Like, follow, and subscribe for quick insights that make you smarter. What is Ebitda, and why does it matter? Ebitda stands for earnings before interest, taxes, depreciation, and amortization, but don't let the jargon scare you. It's basically a way to measure a company's true operating performance by stripping away financial decisions like loans, taxes, and asset costs. Here's why it's important. Focus on core profitability. It shows how much money a company makes before financial and accounting factors come into play. Removes financing and tax differences, helpful for comparing companies, since some pay higher taxes or have more debt. Popular in business valuations, investors and buyers love Ebitda because it highlights a company's cash-generating ability. But beware. It ignores major expenses like debt payments and equipment costs, which can make a company seem more profitable than it actually is. Bottom line? Ebitda is a powerful tool, but it's not the whole story. Always dig deeper. Want more financial concepts from OMM? Drop a comment below.